Welcome, everyone. Welcome. I'm Angelo Robles, and welcome to At Family Office and to my members of SFO Continuity. As always, a special welcome. Well, I caught up with a good friend a couple of weeks ago when I was out at Milken and also hosting some of my programs in LA. I haven't seen him in about a year or two, and it was wonderful to see him. He's one of the great thinkers on tax strategies and understanding from a global perspective things like privacy control and tax mitigation. And I've been looking to do a program on this for a while. So, really excited. It's kind of like the why private foundations are a strategic asset of the world's most successful families. I could retitle that The Billionaire's Blueprint: How Private Family Foundations Preserve Wealth, Legacy, and Purpose, and are, of course, of value back in society. Our special guest today, again, is a personal friend and a cigar cohort of mine. It was so good to see him out in LA over multiple days a couple of weeks ago, back in early May. Our special guest today is Casey Chauhan. He's the founder of Together CFO. He's a speaker, an angel investor, and a philanthropist himself. Casey, great to see you.
Yeah, thank you so much for having me on, Angelo. It's always good to spend time with you a couple of weeks ago and now be on the show.
You're very kind. Great to see you. And it was a pleasure to be out in beautiful LA. Unfortunately, even though back in early, slightly in the midish May, didn't really get a lot of sunshine, but had incredible company and good friends. And more importantly, you're outdoors now. It looks like you're getting your share of the rays and the good vibes of Southern California. But why don't we effectively get right to it? I'm going to start with kind of a pretty hard-hitting direct question. Why do the world's most, I'm going to go with the word powerful families see often what I would define as a private family foundation, not just a philanthropic tool, but that should be most at heart, but as a strategic control mechanism?
Yeah, great questions. Jumping straight into it there. The boxing gloves are on. It's by far the strongest structure, right? So one of the things that we do when I'm presenting on stage and speaking to groups is compare a side-by-side between a private foundation, public foundation, a charitable remainder trust, a DAF, LLCs, all the other structures that you're used to compared to a foundation. So you can see at a line-by-line level what the pros and cons are of the full matrix of things. And I think that really helps people understand that this is not just a tool for philanthropy, but it's actually a really good strategic tool to help reduce taxes, protect assets, create a lasting legacy, as well as totally eliminating capital gains tax. So when used for its full potential, it's by far the strongest structure available.
And we have so much to cover, including on taxes, including on a lot of families maybe under the impression that they need to have hundreds and hundreds and hundreds of millions, and that it's very expensive, it's cumbersome, all kind of myths that in time in today's discussion we'll debunk. But I think it's important to lay a strong foundation. And it's something that I'm thinking about. To me, a big four is having a family office, a holdco, a private trust company, and a private family foundation, kind of the big four of successful families. There's a lot of nuances to that around corporations, LLCs, onshore, offshore trust, and maybe we'll have another discussion that goes a little deeper into the integration and more asset protection. But for today, staying focused on our core subject, how does a well-structured private foundation enhance multi-generational legacy beyond simply a trust or a DAF? And what exactly is it accomplishing?
Yeah, great question. Again, getting really deep into the understanding of this,
we don't waste time.
Yeah, which is fantastic because we've seen it in time again, all these studies that have looked at multiple elite families and family offices, and they all conclude the same thing. By the third generation, the majority of the wealth has totally dissipated, right? So I think we can all agree on that at the family office level, that if we do not educate the future generations correctly and keep them close, it's very, very high probability that the wealth will be squandered. So using a private foundation to help keep the family close on quarterly board meetings, understanding the philosophy of what created that wealth in the first place, integrating new family members into the family philosophy, having that core values and that family ideology, really, so to speak, is what helps keep the family strong as a unit across multiple generations. And if that's done correctly or well, let's use the Rockefellers as a perfect example of that versus the Vanderbilts, that not such a good example, right? Where they squandered a lot of their wealth, still have a big name, but the wealth has definitely been dissipated. And you can boil that down to how well you have transferred the knowledge to future generations. They say that the first generation makes the wealth, creates it. The second generation maintains it to a degree, while the third generation is too far away from that first generation and totally blows it. So with the private foundation can be a great tool to have those future generations and then additional family members as people get married and the families grow to come into and be part of that, and ultimately to let them know this is how we operate as a family, these are our values, this is the types of deals that we look at, this is why, and to continue that on down the lineage. That's really the key part here.
Very important. And I think most of my audience has heard the terminology shirt sleeves to shirt sleeves in 3 generations. There's so many factors that play into that. And yes, I am familiar with the great work of Dennis Jaffe and others that I wouldn't quite say debunks that, but challenges that perhaps arguably overused assumption a little bit. But nonetheless, the concept of it and the fact that the family's purchasing power is likely often dissipated through the generations is one of the advantages from my perspective of a family office, inclusive of a private trust company. But a family foundation, for some of the reasons you noted, is so important. Why don't we focus in on one of them? I would say often overlooked. It enhances family identity and long-term alignment. Maybe that's the word I'm looking for with, here's the key part, with the rising generations. How do you help assure that? Could I make the argument initially it's set up and its philanthropic initiatives may reflect the founder? How does the next gen feel engaged and active and listened to that the foundation represents them as well?
Yeah, you can continue adding into that, right? So let's say the first generation's very close to the Red Cross, it's just as a simple example. The second generation could also be close to that, or it could be close to other charitable endeavors. It doesn't have to just be one, and you can keep adding to the mission and to the purpose. It's not something that is set in stone. It can evolve with the generations and the fast living world that we're all in right now.
Of course, of course. And maybe turning a little bit of some attention to tax efficiency and wealth transfer. How do the best families, to some degree, even their family offices, integrate foundations for maximal tax efficiency, even beyond maybe the typical donation deductions, if I could use that word?
Yeah, no, that's the smart play, right? Firstly, as we know, we speak with a lot of family offices. Not all family offices are using this tool, but they probably should be. That was evident when we were talking at the Milken and at the other events earlier in May. But it's so surprising to me that they are not using that, because the amount of advantages you get from tax, specifically with tax, where you get a deduction going into the foundation. So that's pure write-off to your personal taxes. Secondly, on top of that, you get zero capital gains tax within the foundation. And then on any dividends or passive income that is produced, they call it net investment income, NII. That is only taxed at a 1.4% tax rate, so very, very low. So even if you put a small portion of your portfolio investments through the name of the foundation, you should definitely be utilizing this. Here in California, we're paying close to 40+% in taxes when you calculate it all together, it's pretty ridiculous. So to have a tool that can get you from 40% down to 1% and totally eliminate capital gains is very powerful. And I think a lot of it is down to lack of education as to why they don't have this. And, family office space tends to be very secretive. They don't really share many best practices between families, maybe a little bit more so at the multi-family office level. But when you get into the single family offices, it tends to be a lot less change or openness to change.
And let's talk a little bit about, and you were going in that direction too, so it's a good follow-up. Can you break down how I could even say appreciated assets, maybe real estate, business interest, can be transferred to the foundation for tax efficiency? And if it's a step up in basis, including stocks, is it really always that advantageous from a tax perspective? Intertwine it from a legacy and other perspectives as well.
Yeah, it is. It all depends on how much of the money you actually need to cover true personal overhead. Let's just use your personal mortgage as an example that most people have. You can't put that personal residence into the private foundation. So there's always a calculation and a balance that needs to be done ahead of time. But generally speaking, anything that you would want to set aside for future investments or long-term growth would be primed to go into a foundation and could receive all of those tax benefits that we spoke about.
And maybe what are some of the key differences between donating to, let's call it the private family foundation versus, I mentioned the acronym DAF, donor advised fund before, or simply a direct to a public charity?
Yeah, so the simple one, let's compare it to a public charity. You're making a straight donation, you get a straight write-off. You have no control whatsoever over those funds. Let's just use the Red Cross as an example of that. If you donate it to the Red Cross, they will allocate those funds how they see fit. With a donor advised fund, it is a little bit more tricky because you get a higher deduction. You can get up to a 60% tax deduction by donating into the donor advised fund, which is definitely a positive. But you lose control completely. So you are supposed to totally relinquish control when it goes into the donor advised fund, and there's supposed to be an independent third-party financial advisor that is holding those funds for you, and you are able to say which charities you would like that to go to, although the final decision does rest with the financial advisor. And it does not have to be donated. So there's no requirement on when the donation actually has to be executed. So it can technically sit in a DAF for a decade or two or three. Right now, there's no requirements. But the main point is that you lose control. And that's the big advantage of the private foundation, is that you lose ownership, but you keep control. And it's all about control. When we look at the Rockefellers and the Rothschilds and all these elite families, they are very comfortable with this notion of separating ownership from control, because taxation follows ownership. So if the ownership is in a tax exempt entity, then there shouldn't be any tax. But if the control is still kept with you and the family, and you can still control those assets, whether that's stocks, whether it's jets and yachts and toys, whether it's art collections, whatever it is, as long as you still have control of that, that is the key concept that underlines the main benefit of the private foundation.
Yes, I think that goes back a little bit to some of the titling that we used in terms of, yeah, the old adage, I think attributed to Rockefeller, was own nothing but control everything. So the understanding of what's ownership and what's control is a very important distinction for successful dynastic families to kind of wrap their arms around.
100%. Yeah, I think that's the key. And I think a lot of the times when we speak into multi 8, 9 figure entrepreneurs, first generational wealth, they are still not so comfortable with that notion or that concept. And it takes them a little while to really come round to it. But that is the key, is ownership versus control.
And I'm assuming there's some families, depending on their scale, what they use for their generation skipping trust and all the complexities that this really interplays into. If it is perhaps an issue of some level of cash and availability at death, they could look into a variety of different strategies, including possibly a very significant life insurance strategy and other plays, depending on how it's structured within dynastic trust, that could benefit the family with liquidity when it may need it if they don't necessarily have that per se, and as we describe, the private family foundation.
Yeah, it's one of the most overlooked and underspoken about assets is insurance. When you look at the Rockefellers as kind of a prime example, every single Rockefeller has a huge insurance policy set on them as soon as they are allowed to. So, but from a very early age, and just exactly as you mentioned, that when that does come to mature, it's tens of millions of dollars for the family to then reinvest.
Now, looking a little deeper, and I hinted at it earlier, there is areas around asset protection, arguably regulatory risk. So placing or donating assets into the private family foundation excludes it from estate tax. I would argue, unless it's some sort of fraudulent conveyance, makes it impenetrable per se from creditors. So it's a very powerful strategy all the way around.
Yeah, especially now, as you know, the estate tax limit is going back down. It's going to go down to 7 million in next year in 2026. So from 13 down to 7, it's going to affect even more people, right? So they will need to come up with a solid solution if they don't want to give up 40% of their wealth to the government. So yeah, there's a variety of ways to do that. But again, if you're donating it into a foundation, you kind of double dipping and you get multiple benefits from the same activity, right? Because you still control the asset, you get a tax deduction on the donation, and then you can hold it or sell it without any capital gains tax in that private foundation. So as long as you stick to the rules, there's a lot of red tape, there's a lot of guidelines that you do have to follow, understandably. But as long as you do all that, then it is by far one of the most powerful tools that is so surprisingly underused.
Let's talk a little bit about that from a little bit of planning and structuring domicile and how all of that could play out. Let's assume they make a decision that for part of their assets, their resources, and again, beneficial to society, that a private family foundation is the right move. What would walk us through a little bit of, well, how do we structure the documents? Does it need an IRS sort of stamp of approval? Where do I domicile? Is it structured through an LLC? Talk us through a little bit of the nuts and bolts. It's okay to get a little technical.
All right. So, yeah, again, a lot of variables that go into it. But generally speaking, you apply directly to the IRS. They issue something that's called a determination letter. Ultimately, it's just a letter from them saying that you now have a 501c3. This is a non-operating private foundation, which is very different to an operating foundation, right? So it tells you the classification, it tells you which tax form you also have to file and when your year end is as well. So once you get that letter, that's kind of your rubber stamp to say now you're in the game and you can operate as a foundation. So step one would be that. Then step two, you would look at your assets. What do you want to donate in and when do you want to donate it in as well? So there's a time frame component too, as well as a monetary value or different assets, because you get a tax donation credit can be rolled over for 5 years. But depending on the asset type going in, you could get 30% deduction of your AGI or a 20% deduction, just depending on what is going in. Is it artwork? Is it real estate? Is it cash? Is it stocks? So depending on the asset type, depends on how much of a deduction you would get per year. And that can be rolled over a 5-year period.
And my audience would, of course, be very disappointed if I didn't ask for crypto and Bitcoin and others. How does that play into potentially a private family foundation?
Yeah, the same way any other asset would. So you can donate that in, you can hold it in. And the beauty about that is, again, no capital gains tax. So a lot of our clients that are crypto heavy have donated that in at a fair market value, get a huge deduction, and then have held it in the foundation. Now, there is a rule within the private foundation world that says you can't make any jeopardizing investments. So let's just use penny stocks as an example. If you bet the house on penny stocks, that could be classed as a jeopardized investment and not in the best interests of the foundation. So you do have to be a little bit careful about something so off the cuff or so extreme. But generally speaking, that shouldn't be happening at this level.
And I did interrupt you when we were in the flow of the structuring part. Does domicile matter? I would assume you want a state that's protective of privacy, that has no state tax. So I'm thinking of places like New Hampshire, Delaware, although I've been a little down on Delaware, definitely Wyoming. We know I love Wyoming, South Dakota, Nevada, Alaska. Am I on the right track? Does state really matter?
It doesn't really matter, but yeah, those are the preferable states that you mentioned. Again, another thing that we didn't mention earlier is that if a property is owned by a foundation and it has no mortgage, then you can also apply for a property tax exemption. So there's additional benefits of having a foundation in reducing different types of taxes. And there's a lot of great benefits from big corporations like Google gives you $10,000 a month ad spend. Microsoft does, I think, 2,000 or 3,000 of different cloud services. And a lot of other companies also give you free perks if you are a foundation.
And in terms of the underlying structure, is the foundation technically in the US a C Corp? Is it a other type of entity? How do you do that?
Yeah, we create ours as a trust, but yeah, you can create it as an entity if you wish. Yeah,
And
but it
although
is
that may get a
designated.
little bit into the weeds, are there little nuances and advantages from either perspective, trust or entity, like a
Yeah,
corporation or partnership?
each family is slightly different. I think 90+% of our families all go the trust route because there's additional levels that you could put in as well. We talked about other entities. You could put trusts in there as well. You could have LLCs underneath that hold different assets for additional levels of protection and privacy. Because when you do file your tax return for a foundation, it is public information, it can be searched. So the way around that is to have layers and stacks with it in that filing, and that's the way around that.
And if it's going to be a trust in one of the states that's, again, favorable from that perspective, does it, there must be a trustee, and how does the interplay of that dynamic play out?
At the foundation level, the trustee would be the board or the founder of the foundation. That's not a problem. It actually works to your advantage having a private foundation as opposed to a public foundation because you can just have one board member, one trustee. You do not have to have multiple people on multiple committees and give up control. You can fully retain control.
Is there any such thing in remaining, let's go with the word IRS compliant, that does the foundation per se need to have a business purpose?
Not a business purpose. It would have a mission and a purpose, is the way it's framed. And the mission and the purpose of the foundation would be philanthropic. And then it also has the ability to generate funds. If you look at universities as an example, they're all non-profits. If you look at the NFL, you look at Rolex, these
Wow.
are all non-profits as well. So it, although the primary driver isn't a business operation, it can be passive in owning businesses.
Interesting. Uh, I guess other questions a little bit relative to that would, if the family has a family office, the foundation has assets that need to be managed. I'm assuming technically the family office is having a legal contractual arrangement to manage the assets of the foundation. Henceforth, they're charging the foundation for managing those assets.
Yeah, absolutely. And then, again, you can bring the family and the kids into play here as well. So the kids can also be part of that as well.
Now, that's getting a little bit into the weeds of some of the other advantages relative to a foundation. I've heard about, and I may have my math a little off, but is there a 5% annual distribution that's required of the foundation annually?
It's called a 5% expenditure rule, and it's often misunderstood. Yes, 5% of the asset value of the foundation has to be expended. But what does expended mean? We can break that down into two sections. One, it can mean straight donations, gifts, charitable activity, and or it can mean to cover the administration costs of the foundation.
Ah,
Travel, the office, the payroll, the board meeting, those sorts of things.
so in terms of besides the investment management or through the family office, quote unquote, charging the family foundation, uh, is it possible to have family members as board members that are compensated as part of the foundation?
Absolutely, yes. All the time. We see that time and time again. And it's actually very, very normal and very common for that to happen. Again, it's all part of keeping the family close at a multi-generational level. And that's one way to do them is actually give them roles, pay them for their time so that they have a purpose within that foundation.
Interesting. I mean, I would assume that most really significant billion or multi-billion dollar families, at least in the US, which tends to be a charitably inclined country with the high taxes and tax advantages and estate tax advantages of a private foundation, no surprise. Uh, I was told back in the day that if you're a 50, 100, $150 million family, oh, it's too much. You don't need it. It's expensive. It's cumbersome. I get the impression it doesn't have to be.
No, it definitely doesn't. So, as a prime example of that extreme, we've just seen Warren Buffett. He's donated $3 billion apiece to his three children, Howard, Susie, and Peter. It doesn't have to be, I'm giving away $9 billion to my kids. Oh, sorry, my kids' foundations, not direct. Yeah. So he's given it from his foundation, donated to their foundations for them to do with as they please, right? But it doesn't have to be, especially with companies like us. What we've done is we've taken this complex strategic structure that's used at a family office and billionaire level, and we've brought it down to a multi-7, multi-8 figure first generational wealth creator level. And it's that small piece of the family office that we think has been massively overlooked and will give that biggest bang for their buck in going from being rich to becoming wealthy and creating that lasting legacy. So that's really what we specialize in, is taking something that usually would be held at a $25, $35 million level and bringing it down to, let's say, a 5 million plus level.
And rather bluntly, would a country like the US that has an estate tax, assuming marriage and even maximizing generational skipping exemptions and all that, in my example, upon the death of a second spouse, there's and even added to in some states, there's a pretty hefty federal bill that is owed. I'm not saying families should do this for every penny of their asset, but placing it within structuring a private family foundation, I don't care if you're worth 100 billion, it in theory makes that estate tax bill go to zero, correct?
Correct. Yeah, it does. And that's, again, the value of it for the right type of family and the right type of person is that you get to keep more of what you've worked so hard your entire life for, rather than give 40% of it away to a government that, quite honestly, was very inefficient and in massive debt to the tune of 37 trillion as we speak
Yes,
right
now. Exactly. Although I may not know too much about private foundations, I do know a little bit about our country's debt and challenges and all those things for sure. Uh, in terms of how, I kind of asked it earlier, but maybe a little different twist. How are the smartest families using foundations, not just to give, but going back a little bit to purpose again, to invest per their perspective with impact and be a catalyst for, some would say, change or philanthropy that in theory could last year after year, decade after decade?
Yeah, it's a great question. So there's some special tools within the private foundation. One is called the PIR, and it's effectively, you can issue a loan at a very low interest rate that you're not expecting any real return on. And you can put that into a passion project, like you mentioned there, that can help underprivileged or some charity that you're very close to, maybe buy a building or kind of progress to that next level without formally demanding all of that money back or having a very high interest rate on it as if you were doing a hard money loan. So that's a really great tool that's often not used at all within private foundations that I think should get more limelight and more education around.
In Casey, I wanted to provide 12, 13 questions that give my families, my relationship investors that are active allocators and investors, and definitely family offices, some color around the opportunities within understanding before they just jump into a donor advised fund or a direct giving strategy, which may be applicable. It depends on the situation. But being a little bit more thoughtful and dynastic, certainly the private foundation, what did we leave a little bit uncovered that you would like to share that you think would be important for families to understand?
I think we covered the main points. I think it's to put this into the equation, right? I think a lot of people are not well versed on it, they're not educated on it, and neither are their teams. This is the other thing, right? When we look at CPA teams, when we look at wealth management teams, they are not well versed in this because it's philanthropic, right? But then when you look at, let's just use Foundation Source as an example, as one of the leaders in philanthropy at a high nationwide level, they are also not well versed in what I'm specifically talking about, because what I'm talking about is strategic giving. It's not just giving for the sake of giving to the charity that you are close to. That's going to happen to a certain degree anyway. What I'm really talking about is you have 5 main benefits of using a foundation. The giving is just one of them. You've still got 4 other huge benefits that often get overlooked because the team that you are surrounded with are not experts in it. They are not comfortable with it. It's like asking a brain surgeon to perform a foot surgery or the other way around. You wouldn't want, even though they're both doctors, you wouldn't want the foot surgeon doing the brain surgery or the brain surgeon doing the foot surgery. So you have to be comfortable with the tools that you're working with. And quite often what we're finding more and more is that the CPAs are not comfortable with the strategic giving side of it. The wealth managers don't know it. The bankers don't know it. So unless the families are seeking out specific experts like ourselves, they're often going to overlook a huge amount of tax savings, of asset protection and legacy creation that's going to go amiss because the team that's got you where you are isn't the team that's going to get you where you want to be.
Of course. And although I went down this road a little bit earlier, and I know I'm saying this chuckling, if I'm only a family with 30 million and say I want to start off doing a family foundation for only a million, one, is that financially viable relative to the cost? And two, I'm assuming so, but I don't want to assume, could I continue to add assets to the family foundation?
Yeah, absolutely. So yes, 100%. You can start with as little as a million. That's not going to be a problem because what we're talking about is multi-generational. You're not doing it just for a one-off hit or a one-off
Right.
saving. This is something that's going to last the course through generations. So you're definitely going to get the ROI. You're going to get it in year one, even if you did put $1 million into it. So there's no doubt about that being a good tool, even at that level. And then the second part of the question, you can put as much or as little into it in any given year you like. So if you have some good years or you have some bad years and it's a roller coaster, that's not a problem. It's not like an insurance policy where you have to put a set amount in for a set amount of years or it's game over, right? You're not on that type of requirement. It's all donations as and when you see fit.
And in terms of, I mean, one of the things that I would think about going back to some of the earlier subjects that we spoke about is sometimes we're so focused especially for the wealth creator and entrepreneur, and we think we're the kings of the universe. We may lose a little bit of impact in terms of listening to children and grandchildren, uh, the family foundation appears to be a unifying for the reasons that you noted. One, I want you involved. We're going to host quarterly meetings. We're going to be giving away money, which we want to. And it's not only about me, it's you as an active participant. It almost forces you to say, for the distributions that we have to make, let's not be willy nilly. Are you really thinking about what's important to you in terms of giving away? Is it well thought? Have you even formed a thesis? Have you wrote something about it? Do other quote unquote board members or participants have to approve it? It a lot of life lessons beyond family unity, learning how to think, how to structure, how to go through opportunities, how to make decisions. It's pretty all inclusive.
Yeah, and that's exactly the purpose of keeping the family in there and keeping them close. Even if they start off on the outskirts, just watching the meetings or taking the
Right.
board meeting minutes or just kind of taking baby
More like
steps
an
into
observer.
it.
We call it a board observer. Yes.
Exactly. And then to the point at which when they're well versed and they know exactly what's going on, that they can run that meeting when you're not around. That's got to be the intent here, is that, hey, you're going to start off at the edge of the room on the chair just listening in, but eventually you're going to be running this meeting and you're going to be sat in my seat.
Well, I mean, KC, I wanted to keep it relatively concise. Maybe what commentary in terms of concluding would you have for families of wealth, for high income families, for even generational younger family members that may want to entice or encourage the elders to think more deeply about this? How would you recommend they go about doing so?
So
Where do
as
they
you said,
start?
our website would be a great place to start. We've got the strategic giving blueprint. That it's a white paper that I wrote that's very easy to get the high level of what that looks like. And then we can do a free consultation. You can set up a time on our website, togethercfo.com, where we can go over your family's needs and requirements to first even see if it is a good fit, because it isn't for
Right.
everybody, right? This is one piece of the overall huge estate. It's not going to replace everything. It's just one piece of the jigsaw. So I wanted to put that into context as well and say it's a great tool, but it isn't for everyone. So let's get on a call. We can figure out if it is for you and how much or how little that should be, and whether it should be now or whether it should be in the future, or whether it should never be at all, right? Because each family is unique in its own sense, and to take that away would be a high injustice to them. So we wouldn't want to do that. So read around the subject, understand that you have more options, and don't be limited just by what your team is telling you, right? Because if you just went to the doctor and you listened to that first diagnosis that said you had cancer and you didn't get a second one that said actually it was a false alarm, a lot of bad things could have happened in that interim time, right? So it's the same with anything. Maybe that's an extreme example, but it's the point is still the same, is that to get multiple ideas or angles or lenses on things so you can see things from different perspectives, and that will ultimately help your family in the long term, because that's really what it's all about.
And I gave the example before, by family office standards, modest, $30 million wants to start off with $1 million. There's a perception that people have that, like, ooh, like I've always heard these are $500,000 to $1 million to set up. They're wickedly complex with the IRS. Now, yeah, if you're a hyper complex family with billions of dollars, it could become more complex. And yes, the costs are going to go up. But you don't have to give an exact number because it varies. But when you stated the example I gave, you could probably begin the process structuring and filing of these for arguably tens of thousands, a relatively reasonable number, depending on the complexity and the assets going in.
Yeah, definitely. With a firm, let's just use Morgan Stanley or UBS. You go to some of these big boys and ask for this, they will charge you in the region of a couple of 100,000, let's say 500,000 ish. You come to a more boutique firm like us that very specialist and just do this one thing, you could get that same structure done for anywhere between definitely less than 100,000. So I would say 50 to 80 as a given range, depending on the complexity.
And in terms of and that likely is inclusive of setting up the trust, what domicile to choose, filings for that state, the initial getting the quote unquote letter from the IRS. So there are some moving parts, but again, there's supposed to be a level of regulation and rigor behind it so that's understood, not to bring a negative tone to it, but suppose a family elects that we've done it for 7 years, it's not quite for us. Is there an unwind process if need be?
Yeah, there is. If you did want to dissolve it, there is a process where you can definitely do that.
Understood. Well, wonderful, Casey. It's a pleasure to see you again in LA a couple of weeks ago. Enjoyed a couple of good cigars with my friend. Caught me up a little bit on some of the things happening in the tax world, including what we're talking about today. Everyone, like, I think this is something for a family of substance or a family office recommending to the family that needs to be on the table. And like Casey said, the answer may very well end up being no, but like anything, you have to put in the work to understand it, form a thesis around your assets, resources, and the value it's going to provide to the family, how it intertwines with other structures from family office to holdco to other trust to private trust companies. And it is something that, again, I go back to a little bit of its core purpose. Besides engaging the family in unity, it is doing something beneficial in terms of giving back. It's a charitable inclination and initiative, which we should never forget, of course, that core purpose of good to the heart and providing value, and however we deem it, to entities and others and charities that the distributions can provide. So, kudos in terms of that core understanding. And everyone, I'm Angelo Robles. This is primarily dedicated to my members. So probably in an unlisted YouTube, you'll be the first to get this. And then maybe a couple of weeks later, I'll share parts of it a little bit more publicly. I've known KC as a wonderful tax strategist for years, and feel free to reach out to him. We'll get his contact information in a second. Worst case, for my members really only, you could always reach out to me, and I'm happy to make a warmer introduction to KC. Again, I know we have a lot on our plate. I know this may not be the first thing that you're necessarily thinking of, and many of you look at me more from the geopolitical, economic investing, of course, AI, tech stack, investing, but these are very, very important parts. None of that really matters if there's not, and a reason why my private membership community is called SFO continuity. There needs to be the value of this isn't just about me. It's not just in the short term. I'm impactful, engaging my family, what I hope, generation after generation, passing down values, and that word again, continuity. Now, there's even deeper understanding and reasons behind something like a family foundation. Later this year or into next year, we'll begin to maybe in person at some of our programs go into that more. But KC, you've been amazing. For those that aren't as familiar with me after the fact, you could simply go to angelorobles.com, learn about membership and our programs and the value added that we provide. But more importantly, KC, for those that would maybe like to more discreetly follow up with you, how could they learn more, a website or a way to reach out to you?
Yeah, togethercfo.com is the website. Together CFO on any social media channels will get you in touch with us, and there'll be a call booking feature that you can just put in the details and pick a time, and it'll be scheduled, and we're more than happy to speak to any of your community.
You're so kind. KC, it was great to see you a couple of weeks ago. Great to see you, although digitally, but you're beautifully outdoors now. So it was a great setting. I'll actually be doing some of my programs outdoors on my property and around a little bit this summer too, just to change the flair of my, what some would say is a boring studio. So again,
hopefully with a cigar in your mouth as well and a whiskey.
Well, that doesn't take too much to make that happen. And yes, as I'm recording this with you, privately, it happens to be a Friday. We're heading into Memorial Day weekend. Going to have a great time with family. Look forward to that. Again, always God bless America. So on that note, KC, we really appreciate the information drop that you did. It was very valuable. Members, I hope you enjoyed it. Have a wonderful, although you'll be hearing this after the fact. So I hope you had a wonderful Memorial Day, and you're going to see a lot of me, you better, everyone this summer, because we have a very active summer. KC, again, thank you for your time. Have a great day. Thank you.
Thank you. Bye-bye.